bonds are basically loans that can be traded on the market just like stocks can. They are a way for governments and corporations to get money for their needs. So when the banks get your money, one of the safest assets they put it in are bonds. So what you need to do is buy bonds and problem is solved, right? Well, not so fast. The key feature of bonds is that they are issued for a certain time period. During that time, you get paid interest or what is known as coupon. After that time is over, the bond matures and you are returned your original money called principal. Think about it as the bond having a birth date and a death date. Let's say the German government issues a 5-year 10,000 euro bond. The 10,000 euros are what's known as face value or par value. It doesn't change. The interest rate is 2% per year and that is fixed as a number for the whole time. This is important for you to understand for what comes in a bit in the video. The 200 euros are fixed, not the 2%. So you buy the bond for 10,000 euros. In each of these 5 years, you get 200 euros per year. On the 5th year, the bond, quote unquote, dies or matures, and you get your principal of 10,000 euros back. So as you can see, the first issue here is that you need to wait for 5 years to get your original cash back. At this point, this turns into an investment, not a cash substitute, because you don't have access to it, which defeats the purpose of you holding the cash in the first place. So it's not cash, it's an investment, and it's a lousy investment, but more on that later. Now you might be thinking, well, if it is traded like stocks, then I can sell part or all of it when I need, right? Well, not exactly. Technically, you can, but as I said, since the bonds are traded on the open market, their prices fluctuate all of the time. The only way you are guaranteed to get all of your original money back is if you hold to maturity, or in the previous example, up to the 5th year when the bond expires. If you sell it on the 3rd year, it is entirely possible you will get 8,000 euros instead of 10. Or maybe you can get 12,000. No one knows. The price of the bond is inversely correlated with yields, which means that when yields go up, prices go down, and the reverse. So when central banks raise rates for a whole variety of reasons, the price of the bonds that were already issued drops. This happens because if our 5-year bond that we got from the German government a year ago gives us 2%, but the one they're issuing now gives new investors 3%, then obviously investors have to be fools to purchase our 2% yielding bond for 10,000 euros and get 200 euros per year, when they can get for the same 10,000 euros a 3% yielding newly issued 5-year bond and make 300 euros per year. Remember, I said a bit earlier that the 200 euros are fixed. In that case, they will demand us to sell it for a lower price than the original, or what's known below par or below face value, so that the fixed 200 euros payment becomes 3% of the price they buy it for. Because why otherwise would they purchase it from us? So now if we want our money before the maturity date, we have to sell it for less than we bought it for. Obviously not a good deal if what you're aiming for is to store your cash for when you need it. There are bond funds which are just like stock ETFs, basically a basket of bonds. These ETFs you can sell or buy whenever you want from your brokerage, just like you can with stocks. However, they don't solve the problem at all. They even make it worse. You see, bond ETFs, unlike individual bonds, never expire. If Vanguard has an ETF with 5-year bonds, they can't just let all of them mature, close the fund and be like, sorry guys, that's it. No investor wants that. So obviously the managers of the ETFs have to constantly buy new bonds and let the old ones mature. It becomes a constant treadmill of bonds entering the fund and expiring and entering and expiring. So in that situation, as you remember, it is hard enough to know what the price of a single bond would be in 3 years. Add to that 97 bonds, each purchased at a different date and maturing in a different year, and it becomes totally unpredictable, just like with stocks. So not only do bonds ETF not work as a cash substitute, but they can't even work for you if you want to get the same amount of money back. Here is what TOT, the BlackRock's ETF following the 20+ year USA government bonds, has done. It's down 25% for the past 5 years. Not a good place for your cash. The only reason I would think of to hold long-term bonds is if you have a fixed expense at a fixed date and you want to make some interest on the cash. Let's say you know in 4 years your kid is going to university and it costs X amount. Instead of letting that cash rot away in your bank account at 0%, you can get a government bond at 3%, get 12% on your cash for 4 years, and then get the principal you invested and pay for a university. In that regard, bonds are very good for long-term planning of known and fixed expenses in the future. Other than that, well, it's not the time and place for me to go into that rabbit hole, but I'll just play you a clip.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency.
See, they print it digitally. While you're getting your fixed 3% for 20 years and waiting for the 21st to get your original money back in the same amount, they have already devalued your currency by 300%. Anyways, the video isn't about that, so don't get me started. I just think that if you're planning to hold a bond for years and years ahead as an investment, you might as well buy quality stocks and ETFs that produce stuff, grow their profits, and protect you from inflation. By the way, if you want to find out my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, go to the description, click on the link, and I'll send you my report for free. It will always be up to date regardless of when you're watching this. So, talking about inflation, some people think that putting their cash in an inflation-linked bond will do the trick. Unfortunately, that isn't an option either. Inflation-linked bonds are bonds which have their principal tied to inflation, so when it rises, it goes up. They are often tied to a popular inflation index like the Consumer Price Index in the USA, the Retail Price Index in the UK, and others. So if the inflation for 1 year is 4% and you bought a $1,000 bond with a 2% yield or $20 coupon, the principal $1,000 will be adjusted to go up to $1,040, and now the 2% will be $20.8. Inflation-linked bonds are an interesting instrument, but are not as great as they sound. You need to do a lot of research and have an outlook on inflation and interest rates in order to successfully buy these. If you expect there will be deflation or prices in the economy going down, it's not a good idea to own them because your gains can be wiped out. In our previous example, the $1,040 can go back to $1,000 if there is a 4% deflation. Most inflation-linked bonds offer a floor, so it won't go below the par value of 1,000, but despite that, all of your gains will be destroyed. Also, they play by the same rules the normal bonds do. When rates go up and down, these bonds go up and down too. If you have a situation where a central bank raises rates to be above inflation, which is the case now in a lot of places, then it will be more profitable to own normal bonds and the inflation-linked bonds will crash. This is because the newly issued bonds will have higher rates and will be more attractive to investors. So you basically have to get into the central bank decision and inflation expectations guessing game. Not a fun place to be if you ask me. This is the 3-year chart of a fund containing USA TIPS or Treasury Inflation Protected Securities. It's the iShares USD TIPS ETF. That's just a fancy name for bonds linked to inflation. As you can see, it has lost almost 3% in the past 3 years, exactly when it was supposed to protect you against inflation. And the downfall started exactly in the first months of 2022 when the inflation started getting high. Why is that? Well, because central banks started raising their rates at the same time to combat inflation, and as with normal bonds, when the yields rise, the value falls. So many people who invested in these types of bonds without doing their homework were shocked to see their inflation-linked bonds going down exactly at the time when they were supposed to protect them from inflation. With all that said, our second candidate to hold cash in, inflation-linked bonds, also won't make it. It's as volatile and unreliable as the standard bond. So what are we to do? This video is just a part of my complete cash masterclass. To watch the full version, click on the video that should have appeared on your screen right now. You still haven't clicked.